Greetings on this overcast Wednesday. I hope this finds you well. I just wanted to spend a few minutes talking about interest rates, cash accounts, term deposits, and investment risk, and those sorts of things. It's a fairly topsy-turvy financial world we're working our way through at the moment, and this can be seen quite clearly when you look at the Swiss Central Bank, which 12 months ago announced they would offer negative interest rates to bondholders. So effectively that means you pay the government for the privilege of holding your money for a 10-year period, and they give you back less than what you give them. In an ordinary interest rate environment, you give $100 to a government or an institution, and they pledge to give you back maybe $105 or $110 in 3, 5 or 10 years time. Not the case in Switzerland. You give them $100, they promise to give you $99 back in 10 years' time. Pretty unusual, pretty crazy, but there was no shortage of people queuing up for it, which gives you a bit of an idea that people are quite risk averse at the moment when they're willing to accept a fixed, guaranteed negative return on their investment for the security it posed. In Australia, things are a little bit better. We get 2.5% or maybe 3%. On cash and term deposits, even though the official interest rate is 2%, which incidentally is the second highest interest rate in the developed world. So interest rates are not too bad in Australia for those with money on deposit looking for a return. But 3% is still, it's only marginally above inflation, so a lot of our clients are starting to ask, well, are there any alternatives? What are our options? And so let's have a quick look at them. Firstly, you can put your money under the mattress. It can work for a small amount of money, but not really an option for modest or large amounts of money. It's a storage risk, and it just doesn't work. Secondly, we can just term deposit and rate shop and try and get the 3, 3.25, 2 3/4, whatever's out there, and just pick whatever fruit we can get on the interest rate tree. This is what we're doing for most of our clients, and although rates aren't great, they are better than overseas, and particularly Switzerland, Denmark, Japan, Sweden, places like that, which are actually offering negative rates of return. A third option is, well, we can invest in bond funds, which we do for our clients. You lend to companies, not governments. One of the bond funds we use delivered a return of 3.5%. in the 2015 calendar year. Not earth-shattering, not going to rock your socks off, but a little bit higher than the rates on cash, which is what you'd expect from a bond fund. Another option, which is getting quite a bit of press in the media at the moment, are hybrids or subordinated debt. I won't go into what they are right now. I'll do another clip on them soon, but they are definitely, in my view, definitely 2 steps up the risk ladder, and probably shouldn't be mentioned in the same breath as bonds or cash or term deposits, because they're quite different things in what they are. So if you do see them advertised paying 4% above the cash rate or 6% franked yield or whatever, just bear in mind they are quite different and quite riskier than a cash and term deposits. I'll explain shortly what they are. For now, it looks like investors and advisors and our clients are just going to have to get used to a lower interest rate environment for a little while, and try and see, eke out get what returns we can when they're on offer. It doesn't look like rates are going to be raised sharply anytime soon, so we could be in for a few years of pretty lean returns on cash accounts and term deposits. I'm happy to take any questions or answer any queries you might have on this, and I do look forward to catching up with you in person soon.